Okay, so no good presentation doesn't go without a legal disclaimer. So I'm not going to read the entire thing here, but I did promise our Chief Litigation Officer I would read this, and I do love having my job, so I'm going to comply. The information provided in this live stream does not and is not intended to constitute legal, tax, or medical advice. Instead, all information, content, and materials available in this program are for general informational purposes only. Information on this live stream may not constitute the most up-to-date legal, tax, medical, or other information. This program contains links and references to other third-party websites. Such links are only for the convenience of participants and users. Brown & Brown Inc. and its teammates are not responsible for the content of the third-party sites. So with that, let's move on to our agenda. So we're going to try to cover a bunch of different things today. I'm going to go through the insurance cover considerations, some potential cost drivers that we're seeing and what we're currently putting in force with our current policyholders, and then just a brief marketplace update for the property and casualty side of the business. And Doug's going to go into, as we are considering returning back to work here hopefully shortly, some of the considerations to think about when you're going through those thoughts and some of those plans. And then also from an employee benefits side, the consideration for cost and risks. And then unfortunately, if you're thinking about furloughs or layoffs, along with some of the recent legislation. And then lastly, we're going to share with you the resources that we have available for the community. So really kind of starting, what do you need to know? So one of the most important things, we're all really in the same boat here. So you can't over communicate enough, but you do want to make sure you're communicating accurate information to your teams, to your clients, and to your vendors. So we've been kind of going to the trusted sources. There's a lot of conflicting information out there. Unfortunately, every time you turn on the news or you turn on the internet, you can hear something potentially different. So we want to encourage all of you and all of our respective teams to go to the trusted sources. Those sources that we've been relying pretty heavily on throughout this process is the CDC, the World Health Organization, and of course, OSHA. In addition to that, this is the link that we have for our current online tool, which we'll review at the end of the presentation as well. There we've got some frequently asked questions, resources, and of course, those recorded weekly webinars. So I can't stress enough, just basically going to those trusted sources. So the next slide, this is one that I have used. I can't tell you how many times I go to it, a couple times a day. So just really, where are we today? So if you look at the state of Florida, total cases were just over 28,000 cases, a little over 4,200 hospitalizations, and unfortunately, we're almost up to 900 deaths. So if you peel that back a little bit and focus just strictly on Leon County, total number of cases that we're looking at for Leon County, we're at 186 cases as of 11:30 this morning. We've had one related death and 26 current hospitalizations. And then now the big thing is talking about testing. This website also has a great tool for testing. So Leon County is at a total of 2,579 tests. Out of those tests, you have 186 that have tested positive, 2,381 that are negative, 2 of them were inconclusive, and then you have 10 that are currently waiting results. So moving into the actual insurance portion of our presentation, the property policy is where the potential for some of the largest losses are going to stem from. This is hands down the number one question we get on a daily basis is, are we covered, and are we covered specifically in regards to business income? Unfortunately, 99.9% of the time, the answer is probably going to be no. And I'll explain what I mean by that. So with that being said, on a property policy, in order to have a covered business interruption claim, you have to have 3 triggers or 3 things. First and foremost, there has to be property damage, physical property damage. Unfortunately, in the case of COVID-19, that's not that easy to determine. And other perils or other claims that we typically are looking at, you're looking at a fire loss, you're looking at a lightning loss, you're looking at a hurricane where there is physical damage to the building. Now, there's still some speculation out there as far as if the actual contamination of COVID-19 would lead to a physical loss to try to hit this coverage trigger. But of course, a lot of that is probably going to be challenged by the courts. The second thing, cover location. This is pretty self-explanatory. The specific location needs to be addressed and scheduled on your policy. And then third and lastly, it has to be a covered peril. If you're looking at your property policy, the majority are going to have a special form policy, which basically means all perils are covered with the exception if there is an applicable exclusion. And that kind of leads me into my next slide. Unfortunately, ISO, which is the governing body for insurance policies, issued an exclusion back in 2006 and is commonly found in most property policies. And it was started in 2006 in response to the SARS issue, the bird flu, and believe it or not, anthrax. So as you can see here, the intention of this exclusion is to specifically limit or exclude coverage. So if you look at the exclusion in itself, it says we will not pay for loss or damage caused by or resulting from any virus, bacterium, or other microorganisms. And then the exclusion goes on specifically to state business income, extra expense, and civil authority. So it really encompasses almost all lines where you potentially could have a property claim. So realizing this exclusion can be on a large number of those policies, there's still some things we want you to be aware of and potentially plan for. First and foremost, we anticipate a large number of claims for the loss of income or the extra expense component and basically just overall delays in general. We also expect claims for dependent properties or from dependent properties and potentially from civil authority if it's included in the policy, which would be due to any stay-at-home orders. But again, it's you need to refer to your individual policies because that exclusion is going to be prevalent. Keep in mind all claims are going to be different, and I can't stress enough that the devil is really in the details. You need to review your policy. Every policy is issued a little bit differently. Just don't assume that that exclusion is going to be on there, or potentially there may not be a sublimit in the policy that could potentially pick up some coverage. With that, one of the areas that we've seen some policies that do have sublimits for business income or potentially event cancellation, or it could pick up cleaning, sanitation in the event that you do have an impacted workplace. And a lot of those policies are very specific to maybe healthcare or manufacturing or other industries. So again, just make sure you refer to the policy. And one of the areas that we've often found that's overlooked, which is uncommon, but a lot of our businesses have vacated their buildings and are working from home. So there's certain conditions that are in property policies. So you still have duties and obligations to protect your property in accordance to the property policy. Some of those duties include maintaining security, locking doors and other openings, making sure the fire sprinklers are working order, power down any non-essential equipment, and then also removing waste. So it'd be really unfortunate if you had a legitimate property claim and the carriers would try to trigger this particular provision. So make sure if you're not in the workplace, make sure your businesses are being protected. And again, I can't stress, we don't know what the future holds for any of these items, but I can say without absolute certainty, the better documentation and records that you keep in response, the better your chances can potentially be if recoveries become available. So what we've been telling our clients is make sure you track all of your extra expenses, any payroll, loss of income, and a good note would maybe to be put it in a separate account and make sure you document that. And if you need help, enlist the help of your CPA or any other financial partners to recreate those records and also timelines. So I can't stress enough, make sure you review your policy. Potentially, most of you have probably never been through a business interruption claim. They are not cut and dry, and I can tell you it's a very labor-intensive process, and if you've been through one, you know exactly what I'm talking about. So in an effort to help our customers, we have developed a checklist and a spreadsheet that goes along with the checklist to try to help organize what information you should be looking for. And I'll tell you, just to give you an idea, every business is a little bit different, but this spreadsheet has about 20 tabs. So the details are extremely key. But what we're just trying to do is put your mind in the mindset of what are some issues and what are some business categories that we can potentially file a claim for. And I think it's been extremely helpful to try to ease the burden for those business interruption claims. So moving into the workers' compensation, we've fielded, this is probably the second largest questions that we get are from a work comp standpoint. Again, just like every other coverage, work comp guidance is changing weekly. So work comp is regulated and made state regulated by state statutes. So keep that in mind if you have employees and locations in other states. Each state is going to be very specific and the mandates will follow that statute. So you're going to see some variety there. But in the state of Florida, the work comp statute states in order for a claim to be compensable, the injured worker must show the occupational diseases peculiar to a certain trade or employment. So what that kind of means is think of those trades like healthcare or TSA workers, or folks that are in senior living facilities or first responders. Those type of claims are probably going to be a lot easier to decipher, but really still the underlying question, and we haven't seen a whole lot of claims rolling in from this segment, but I would anticipate maybe some more as we move down the road. That question is, most claimants and carriers are trying to address, how do you prove that you got the virus from your place of employment? COVID-19 is not cut and dry, as potentially some of our other occupational diseases that we see from time to time, such as, lead poisoning or black lung. So as a standard, our advice is always to report the claim and let the carrier go through their process. So make sure you always report that. The NCCI is one of the main governing bodies on work comp, and they're also attempting to provide some guidance by contemplating changes in potential class codes and payroll rules that are specific to audit and remote workers. So one of the things, if you were lucky enough to be a part of the PPP program, you could potentially have workers that are being paid, but they're not working. So think about those audit issues. Those are always fun to go through every year. But the NCCI is working on a rule as early as this week to make sure those wages potentially are not picked up at the audit. So more details to follow on that next week, but if you just make a note of that, if you do have employees that are in those situations, it's something to keep track of. So while all these items are aiming to try to provide some clarity in what's covered and what isn't, I think every claim is going to be unique and each situation is going to be a little bit different. So make sure you just report it to your comp carriers and let the process kind of carry out. Just another couple of areas we wanted to make sure that we pointed out. From a claim standpoint, just like auto claims, there has been a dramatic decrease in claims that have been reported in the last 30 days, just because we have less people that are out in the field and that are in the office and so on. But we are expecting, at least from what we're hearing, there's an expectation we could potentially see an increase in ergonomic type claims, back claims, neck claims, carpal tunnel claims. So with everyone working from home, they may not be working in the most comfortable and ergonomic workplace or work environment. So we're potentially going to see an increase in those claims. So I can't stress enough, we've been doing it here with our agency, but the need for virtual safety meetings is more important than ever. And a lot of us just aren't really accustomed to those virtual type settings. And I think we're all getting pretty good with technology, but that's something that I would definitely consider. And then from an injured worker standpoint, just some challenges that we're seeing out in the current workforce. If you do have an employee that's currently in the work comp system, but they're in a light duty restriction or a return to work program, this is definitely, put up some challenges. So those are some things to think through. In addition, if you're a drug-free workplace, you're getting the credit on your work comp policy, you still have to adhere to the requirements for the pre and post and random drug testing. So make sure that you're staying up to date, with the challenges in that environment. And lastly, I'd say too, just remember to report those claims to your carriers and let them go through the process. I think every claim is going to be unique, and only really time will tell how it's going to play out. So a couple other lines and coverages we wanted to address are the casualty lines, and a little bit easier to predict here, but still presents some gray areas as far as general liability. So general liability is basically a third-party coverage for any bodily injury or property damage. So for businesses that may still be open or planning to reopen soon, how do you prove an injured, party or person has contracted or is claiming to have gotten sick from your place of business or from one of your products? So that's where I think we're going to see potential claims from customers, suppliers, and vendors from a general liability standpoint. And there typically is a total pollution exclusion in most general liability policies. Not 100% certain if that exclusion is going to apply or not, but just something to keep in mind. Another area where we're seeing a lot of questions come from is the auto policies. We're seeing a lot of changes in how employees are using their vehicles, specifically for delivery. Most of our carriers are broadening the coverages for what we call higher non-owned autos, but you need to verify that with each one of your individual carriers. So I know Nationwide has done a really good job, but you could potentially be in a business where you don't have a fleet and you typically don't have folks that are out there on the roadways, and maybe you don't have an auto policy, but now you have folks out on the road. So that is definitely something that you need to make sure that you're addressing. And then for the businesses that have fleets that are out there, but you're looking at potentially a suspension in coverage, do you have vehicles that are currently being parked or not in use? So the carriers don't like to do this, but I would go back and request what we call layup credits or suspension credits for those vehicles that are not being used. And there could be some additional hoops that you have to jump through, but it can relieve some premium. And then just some other things to think about, as far as radius of operations. Potentially if your policy is rated on 200 miles or more, 100 miles or more, 500 miles, and now you're either not hitting those radiuses or you're on a much more smaller local level, those are things to consider when changing radius of operations or class codes. So keep those in mind. And then the last thing too is a lot of times we see a number of employees in more normal circumstances that are driving together. So be careful with those circumstances and make sure that you're trying to practice social distancing as best as possible when you have drivers that are in the same vehicles. The last thing here, which is special event policies. Depending on the policy form, these are very manuscripted policies most of the time. And there could be potentially coverage in there for viruses and communicable diseases. So be careful with that. We're expecting to see significant losses in the industry in this line of coverage. So I just put a few of them that you probably are aware of and you've heard about. But the Olympics alone, I think we're estimating, or the industry has been estimating those losses to be, just for the Olympics alone, over $1 billion. And then Wimbledon was another one that was publicized. They expect the losses to be, in an excess of $140 million. So I know there's been countless local events for our nonprofits and concerts and sporting events that have been canceled. So hopefully you're able to postpone and recreate some of those events further down the calendar year. Just make sure you're careful when you're securing those special event coverages. I think we're going to start to see a lot of additional exclusions. And just going back to where those policies are all not created equally, not saying there may be coverage, just something to think about as you're securing potential special events coverage in the future. A few other insurance considerations, thinking about executive liability. So directors and officers coverage for public, private, and nonprofit organizations. These policies are going to be tested, I think, in the future as well. So potentially could be looking at claims that allege mismanagement, incorrect financial guidance, potentially wage and hour claims, failure to purchase adequate insurance, those type of instances. But just remember, again, there is no standard policy for directors and officers coverage forms. Each carriers tend to manuscript their own forms here. So be careful if you do have a policy, make sure you review it. And just like I said, there are so many different manuscripted forms, just to be careful. And then also from an employment practice standpoint, so just to go down that road, this is coverage for wrongful termination, sexual harassment, age discrimination type claims. Just a reminder to make sure that you're being consistent with who maybe is working from home or working remotely, who isn't, along with documentation of hours. If you're potentially considering layoffs or you're considering furloughs, make sure, one, you hopefully have an employment practice liability policy, but also to make sure you're seeking legal advice first before you put any of those plans into place, because we do think we're going to see an uptick in EPLI claims. And then the last thing on this slide here is the cyber liability. This is definitely an area of concern for all businesses. I know we scaled up really quickly as an organization, getting folks to work from home. And with that, the hackers are having a field day. They're taking advantage of these type of situations with a quick scale up of people working remotely. So we're starting to hear stories about, some of our hotels, our financial institutions, and more recently, even this morning, I think I read an article that the World Health Organization and the Gates Foundation were hacked. So if entities the size and sophistication are being breached by cyber criminals, it's going to happen. It's just a matter of time. And I was reading an article earlier this week too that the FBI put out. So over the same time period last year to this year, of the last 2 months, they're receiving 4 times the amount of complaints for cyber incidents than they were last year. 4 times. So last year, same time, on a monthly basis, they were receiving about 1,000 complaints a day. 1,000 complaints a day. And it's ginned up to a little over 3,000 to 4,000 complaints. So be careful of what's going on there in that environment. And just knowing with schools closing, we have parents that are working from home, and employees could potentially be using personal devices. And unfortunately, there may be some crossover with, kids and parents working on the same machines. And that just adds, potential exposures and perils there from that standpoint. So something to think about. Make sure you're taking it seriously. And I think the most important thing to take away from this is make sure that you're engaging your IT professionals from that standpoint to see if there's anything you could do to avoid those type of circumstances. So I want to shift gears and talk about what are some areas, cost drivers, where you could potentially save some money, or potentially just make sure you're not overlooking certain things that are currently on your policy with these uncertain times. So a few items to consider. Make sure this is a good time to review your current exposures. So if you're looking at your workers' compensation policy or your general liability policy, those are exposures based on sales and payrolls, and also maybe potentially looking at some limits. So if you're not on a monthly self-reporting basis from a work comp standpoint, more of a level premium, that's something you may want to consider for your renewal, or potentially midterm to go on more of a pay-as-you-go system or a monthly self-reporting. Some of the general liability policies are on what we call a minimum deposit basis, and it may be a good opportunity to take a look at those and address it specifically with the individual carriers to see if you can get some relief from the minimum and deposit issues. And again, I talked a little bit from an auto standpoint, those layup credits or the suspension credits, and then making sure you're reviewing those radius of operations, miles, and classifications on the autos. There could be some potential savings there, especially if they're not in use. And then one of the things that I just added to this slide is looking at your job functions. Do a thorough review of the job functions and the class codes that are on the policies. A good question to consider: are your employees still doing the same thing prior to COVID-19, or have their responsibilities changed? And maybe have your products changed? We have a manufacturer that was manufacturing a certain product, and the supply or the demand went by the wayside with COVID-19. So they actually shifted gears and started producing some PPE equipment. And when we were reviewing the hazards, believe it or not, the PPE equipment had a lower rate. So we were able to change their classifications midterm on their general liability policy to help them reduce some of the cost from a premium standpoint. So they may be rare out there, but it is, something to point out, just something not to overlook. And then also reviewing deductibles. Most of your deductibles or coverage limits are set by specific contracts. May not be a bad time to take another look at that. But what I do want to stress is now is probably not the time to make any irrational decisions from a coverage standpoint. That could have a lasting financial impact if, God forbid, you did have a claim. So, and that's why I always just say, practice your best risk management principles. Urge you to stick to your core risk management processes and principles, but have those conversations with your trusted advisors and see if any of these ideas or cost drivers may potentially work for you. So just an update from an insurance carrier standpoint on this slide. Most of you on this call have probably seen some of the marketing materials coming out from our personal lines carriers with rebates and reductions in premium. So this is probably the third most asked question that we're receiving. And we're also asking our carrier partners is, hey, are the commercial carriers going to follow suit from the personal lines companies? They've already kind of gone out there and decided for the last 2 months and moving forward, they're going to reduce premiums by 10 to 15%. And some of them have adopted some different formulas, but all in all, you're going to see some return premium from the personal lines carriers. The answer on the commercial side is maybe. So just recently, last week, Chubb Small Business adopted a reduction in premium program for all their small business accounts. Unfortunately, Chubb Small Business does not have a large presence in the state of Florida. So stay tuned to see if we have anybody who follows suit. So we have been proactively reaching out to all of our trading partners. And I can tell you Nationwide, which has a strong presence in this area from a commercial standpoint, they recently came out with, they're not going to have any current reductions on the current policies, but they plan on relieving premium increases for renewals. So I would say probably look for more ideas along those lines, but every carrier is going to be a little bit different. And I can just tell you what we're doing as a company, Brown & Brown's senior leadership team, as well as our local leadership teams. We're in constant contact with all of our major carriers, and we're constantly discussing potential solutions to help our customers. So this is a very fluid situation, and I continue to think we'll have updates from our carriers. And I'm happy to say most of our carriers seem to be honoring the memorandum issued by the Office of Insurance Regulations. So if you haven't seen that, that was issued, I think, on the 25th of March. And basically, it's encouraging all of our carriers to basically relax due dates, potentially waive late fees and allow for payment plans, as well as extending grace periods. So if you're having individual issues with this, I would say reach out to your trusted advisor. They really need to be adhering to those, to the memo. And if they're not, the Office of Insurance Regulations need to be notified right away. But I can tell you most of our commercial carriers have stepped up to the plate on that. So wrapping up, what's next? We would ask that all of you continue to be patient. Coverages are going to be tested and challenged, I think, in many ways for the future. And it's probably nothing's going to change overnight. Continue to document all the items that we discussed for all those individual lines of coverage. The more detail that you have, the better off I think you're going to be. There's several lawsuits out there, and I noted a few of them. They're going to run their course. Each one of these suits, basically, they're challenging the business income language that we reviewed in the exclusions and all the respective policies. So I can't stress enough, review your policies in great detail. And I can tell you, and I don't know if this is going to go anywhere or not, but there's been discussions of potential government involvement, at least on a small business standpoint in regards to business income. And I would say it's very similar to what we saw happen after 9/11 with the Terrorism Risk Insurance Act. So stay tuned on that front. It potentially may be, federal involvement with the Pandemic Risk Insurance Act or some form of a federal backstop to step in. So I think if that does happen, you want to be prepared. Just like what we're seeing in our state with the unemployment issues, I think they've processed 6% of the unemployment claims. The folks that are ready and prepared to be standing in line first, I think that's going to be, it's going to behoove you and it's going to be in your best interest to do that. So that's what we're guiding and kind of telling the guidance for most of our clients. If they can do it and they've got the resources to do it, go ahead and do it now. And then last but not least, as if the pandemic was not enough, we're now less than 45 days to the start of hurricane season. And unfortunately, it sounds like the experts are predicting an above average season. So make sure you go through your hurricane plans. And I think we're familiar with that process, especially here in Leon County and Tallahassee. Unfortunately, the last 3 or 4 years, those plans have been tested. But make sure you take another look at that. And then briefly, I wanted to talk about the commercial marketplace just in general. We're coming off of over $200 billion in losses in 2017 and 2018. The pandemic has put an added stress on basically an already volatile commercial property and casualty insurance marketplace. Carriers have been increasing rates and reducing capacity and starting to limit commitments. And at the same time, they're starting to make significant underwriting changes due to their unfavorable loss ratios. So I can tell you the timing of this is not great, and we'll just have to see how this plays out. But I've been in the business now for 15 years and have been through 2 hard markets prior to, or basically it was the hurricanes of 2004 and 2005, then the recession in 2008 through 2010. And all I can say in each one of those tough times, we're able to help our clients navigate the insurance marketplace, and we're able to practice good risk management principles to provide creative solutions and guidance. So this pandemic is going to be no different. It's going to provide some challenges, but I feel confident that we'll be able to get through it. So to reinforce, I think we all are in an information overload standpoint right now. There's no doubt this is going to have a huge financial impact across all industries and including insurance, and could potentially have some solvency issues with carriers. But I would say at this point, make sure that you're getting accurate information and complete information, because again, I think there's going to be a lot of inaccurate information that's out there in the marketplace. So in closing, I'm first going to say, and I think you probably have seen this model, and I am by no means, I'm not a medical professional, but regardless of what you believe, we're starting to hear the potential impact, or there could be a potential second wave or peak coming in the fall. And all I would say is now is the time to start working on that pandemic plan. We all have CAT plans for a fire loss or for potentially a hurricane loss. But I would bet that very few of us probably had plans for pandemic events. So use this time wisely to try to create a plan so we come out of this prepared, and hopefully there is not a next time, but we'll be prepared from that standpoint, God forbid if there is one. So some of the resources we've been sharing with our clients is, okay, what does that plan look like? Because we're going through the same motions as a company ourselves. So when you're building a plan, I think these are some important areas to consider. Tracking closures, who would have thought that would be something we would have to consider? State and local ordinances and orders, but also school and daycare closures. That's had a tremendous impact, and I think everybody's business. So making sure you're staying up to date on that, but establish protocols, sound protocols, make sure you have a strategy. And I can't say this enough, make sure you over communicate that strategy. And then one of the things that I think has come out of this is don't underestimate the challenges with behavioral health issues with your teammates. So with that being said, I know we'll get through this together and we'll be stronger on the other side of this crisis. But I hope that's been helpful. So I'm going to turn it over to Doug. And Doug, hopefully you're not on mute and I haven't bored you to death with property and casualty stuff. So with that, I'll turn it over to Doug.
Thanks, Greg. I actually just woke up. That was invigorating. No, I'm just playing. I'm going to take a few moments. Greg gave me a perfect handoff here into the return to work like returning to the workplace and potentially what that's going to look like for us, and some different protocols and procedures maybe that HR managers and leaders need to be taking into account as employees come back into the workforce. So that's going to be one of the areas of my topic of discussion. I'm also going to touch on the recent legislation enacted, as well as the employee benefit considerations and potential speculations on rating impacts. And then I'll be wrapping up with a discussion about layoffs and furloughs and what we're seeing there. You'll notice here on the first slide that I've put in here, it almost looks like a humorous slide, but I think it paints a real illustration of what we could see when we do begin to return to the workforce. And so again, as our HR managers and leadership teams start to collaborate of what procedures do we need to put in place, what is that going to look like? And on our last COVID-19 call last Friday, our in-house epidemiologist, Dr. Louise Short, was going through some of those, and that's where this slide came from. And I think what we'll start to see is potentially new cleaning and hygiene protocols. Will employers start to establish checklists for our workspace? Is the onus going to be on the employees now to be disinfecting their workspace at the end of the day? Typically we have a night crew that comes in and vacuums the floors and takes out trash, but they're not really addressing some of the other concerns that have been exposed by the COVID-19 pandemic. So I think you'll start to see those type of protocols in place. Social distancing. I believe we, in the last 4 weeks, as a response to COVID-19, have seen a very effective result from social distancing. And I believe that will continue into the workplace as well. I believe that we're getting more accustomed now to, unfortunately, socially distancing ourselves. When this all first begun, there was the conversations about the death of the handshake. So we'll have to see where that all leads and where that takes us in the workplace. But, some other ideas and some things that I have been working with clients on is, currently in the workplace, we do have policies for hurricane procedures. We have policies for fire. And in the recent few years, unfortunately, we've had to get more accustomed to the workplace and having policies for things like active shooters and our reactions. And so now, will we have policies in place to address the pandemic or a widespread illness? And I do believe that we will. I can tell you, I have worked with a few clients very closely in providing them pandemic response plans, some templates that they can review and potentially adopt, along with contagious disease policies and things along those lines. So those are things that we're examining and looking into and talking to our clients about, as well as what type of screening procedures can be put in place. Most definitely, it has been widely talked about that as a result of COVID-19 and employees rushing back to the workforce, will we have a testing procedure to test for antibodies of COVID-19 to test for antibodies and a resistance to potential future illness? So those are things that we're going to be examining. Greg, if you don't mind, I would like you to go to the next slide for me with me here. Next, while we're maintaining and monitoring all this, as Greg said, it's very fluid. So we're looking at all of these protocols potentially that we're working with clients on. All the while, we're still maintaining our benefits consultant roles as well. And as we look forward to not only returning to the workforce, we also have to look forward to the future. And what does that look like? Well, as of right now, we're seeing this drastic impact on our health insurance and our private insurers. But I have to say, as being a broker on the broker side, the response from our private insurance partners, Capital Health Plan, Florida Blue, it's been fantastic. They have been clearly communicating to their broker partners. If you're with Capital Health Plan, they have been very effectively communicating with their member and employer groups as well through bulletins and updates on their webpage. And I think early on we saw, with all of these carriers really following right in lockstep, we saw very quickly that they began immediately to cover the testing for COVID-19 at 100%. Then they gravitated towards covering all related expenses for COVID-19 for things like an inpatient admission, emergency room visits, telehealth. They across the board, our carriers have really stepped up and jumped into that full speed and making sure that their members are taken care of if they've been affected by COVID-19. The other thing that we saw was the special enrollment periods. Most of those have concluded to date, but all of our carriers did allow for special enrollment periods where an employee potentially who had foregone enrolling at a plan anniversary open enrollment would now have a week or 2 week period where in prevention of they could enroll in a healthcare plan through their employer. So we did see that, which was a fantastic response and totally really out of the normal, which was great of our carriers to take that step. And also we saw a quick reaction. I believe our carriers had great foresight on this with shelter in place requirements. The carriers understood members still need access to their prescriptions. And if they're immunocompromised or they're in a high risk category, the carriers don't want to put those individuals in further risk for exposure. So they allowed them to receive early refills. They removed a lot of the quantity limits on prescriptions. And then actually following suit to that were a lot of our big box pharmacies, CVS and Walgreens, have also started now doing delivery services of pharmacies. So, that was something we've seen a drastic change in the way that these carriers have reacted and the steps that they've taken for their members. A couple of things that we are keeping our thumb on, and Greg talked about it just a few slides ago, is this second peak. There's no doubt, I think most of the renowned physicians are anticipating a second peak, and we're planning for that. One of the things that we don't know at this time is if that does occur, how will the carriers react at that point? A lot of these 100% waivers of the cost share for members, they end on June 1st. So once we get past that deadline date and we had to have a peak in the third or fourth quarter, will the carriers then again circle back and establish these waivers for member costs? And I can tell you, I've talked to some of our partners. They are taking that all into account. They're discussing it, and we'll have to keep you monitored and updated on where that goes. On an ancillary carrier side, a lot of the carriers here are providing really rate relief or carrier relief strategies. And that would be along the lines of your dental insurance, your vision insurance, your disabilities, or your worksite products. So a lot of our carriers, your standard insurance, your Guardian, your Sun Life, they have guaranteed rate stability. And they've gone back and offered that for renewals between May through August. So what we have seen for some of our early released May renewals, when they were initially released, there may have been an increase on the dental plan or something like that. If you have received that, you need to talk with your broker, have a discussion about them going back to the carrier and jumping into this rate stability period to get you relief on that potential rate increase. Some things to keep in mind as far as the overall coverage with disability. Most disability insurance policies do not specifically address the COVID-19, and they sure don't address working from home as part of a disability or social distancing as a disability. So those typically are not going to be covered under any type of disability for an income replacement for an employee. However, there are typically specific quarantine riders that carriers do have available. So as Greg mentioned previously, the real governing documents here are going to be your plan documents or your policies. And I can tell you with our carriers, as we've been reaching out to find out the reactions of those carriers in regards to disability, Guardian Life Insurance and Sun Life both have come out and discussed that they will provide some type of benefit, or there may be a trigger in their policies. So if you currently have Guardian installed within your group or Sun Life, you may go back to your broker. You may contact a liaison that can get you in touch with your plan documents and review those for you to find out whether coverage could apply, because that's going to be really important to your members. Overall, across the market with just a generic, most carriers, they understand that during something like this, there's potential for financial hardship. So pretty much all of our carriers across the board have extended grace periods for premium payments. One thing I will caution on this is if you plan on fully maximizing the grace periods, Keep in mind that carriers do have contingencies for claims holds, which means that once you go beyond 30 days, they will sometimes revert back to pausing any payments or claims processing. So talk to your broker about that and get some additional information. A big key, and Greg kind of alluded to it when he talked about premium returns for the insurance on your personal lines, is medical loss ratio rebates. The Kaiser Family Foundation has projected that $2.7 billion will be returned to employer groups in both the large and small spaces in the form of a medical loss ratio rebate. If you're not familiar with those, again, contact your broker, have a discussion with them. Feel free to contact me. I'm happy to discuss those with you, but you might have some potential relief there as well. And as an overall response to COVID-19, we've seen a lot of compliance questions and concerns that have arisen for ASO and self-funded groups, and potentially amending plan documents due to the responsibility to pick up 100% of the costs for COVID. So Greg, if you'll go to the next slide, this is really the billion-dollar question. And this is where a lot of my clients, as we're having discussions right now from this May to August timeframe, and we're discussing the renewal and strategy. Not only are we talking about the current renewals, but we're now starting to talk about, well, what's the impact going to be for our 2021 renewal? And I am not an actuary. I'm not working for the carriers. I'm just merely going to be speculating on what my experience has been with these types of, not a situation like this because there's never been one, but with all of the dynamics that we would see, and then a decrease in utilization or an increase in carrier pickup for costs. So we take all that into consideration. We're taking, for our clients, we're talking to them about what the population risk of their group is. That would be, if you're a low group, illustration would be you have the majority of your workforce working from home. They're social distancing. They're being very responsible. A high risk population risk group would be someone who's also being responsible, but they're on the front lines. And a good example of this would be a healthcare provider or a grocer, someone who's in direct contact with people every day and exposed to the risk. Then we're also looking at the funding types. Is the group ASO or self-funded? Is the group fully insured? And are they sharing the claims and cost impacts over a large group, like a pooled risk? Or are they like Capital Health Plan, where they're more member or locally centric on a community-based rating platform? Those are all things that are taken into account here. And of course, the utilization mix. Is the group heavy on generic drugs or specialty drugs? Is the group more inpatient and outpatient hospitalizations, or are they more general physicians, or are they very high emergency room utilization? And then with COVID mixed in there, and this is the dynamic that we've really never seen before, is when we're talking specifically with one group about what these premium impacts could look like, you have to take into account the actual population health of that specific group. And the Kaiser Foundation released that approximately 21% of each employer group is in some way, shape, or form immunocompromised, which would mean that they are at a high risk for COVID-19 or for implications due to COVID-19 diagnosis. So with that, we may see that a carrier that has a group that has a high risk group or demographic contracting COVID-19 and being diagnosed and having implications, that's going to drive much higher costs than a group with a lower health risk population. So we have to take all of those into account when we're looking at making speculations on renewals. I don't believe that carriers are going to use this as, well, we now have picked up 100% of all costs related to COVID, so we're going to push that back on our employer groups, especially since the CARES Act provided some relief for the private insurers in response to waiving those member costs. On the dental and vision spectrum, this is pretty simple. This is very easy. We have virtually eliminated the services of dental. Nobody's going to see their dentist. Nobody's going for oral cleaning unless it's an emergency. We've seen a drastic decrease in utilization here. So we do anticipate rate relief or rate decreases in the future. With disability insurance, your short-term and long-term insurance, we are expecting increased premiums. And the reason for that is the premiums that are currently being paid to carriers are currently being invested in assets and bonds. And the carriers are using those reserves to pay claims, disability claims. And with the recent reduction in interest rates, that is really putting pressure on these carriers for future claims. So with that lowering of reserves to pay claims, we anticipate that disability carriers are going to be increasing their upfront premiums for those benefits in order to offset those lower reserves in order to pay your members' claims. When everything occurred with the COVID-19, when it first arrived on queue in the United States, a lot of employers had a really quick reaction to immediately start discussing layoffs and furloughs. And with that, you might have a reduction in the population of the group, obviously. And on the medical side, most carriers, actually every carrier contract I have read, has a clause in there about re-rating. And that typically means that if a group changes the population dynamics or enrollment by 10 to 15%, the medical carrier can go back and re-rate. So be aware of that, because you may see an impact due to a layoff or a furlough, which has also been addressed through the CARES Act and the PPP through requirements there. Segueing into the layoff and furlough a little bit deeper. At first, again, this was really hot topic, a lot of questions about this. And then it kind of died down during week 2 and 3 as a lot of employers waited to see what legislation was going to occur. Now we're starting to see that the PPP funds were released. Those groups that got the funds are maintaining status quo typically, and they're continuing forward. Whereas the groups that didn't receive PPP funds are now having to re-strategize and re-examine layoffs and furloughs. But a lot of times groups are getting these confused. So a furlough maintains the employer and employee relationship, whereas a layoff terminates and severs that relationship. But both instances generally allow the employees to collect unemployment. But the main difference between a layoff and a furlough is in the benefit continuance. Greg, if you'll go to the next slide. So a layoff is a COBRA triggering event. And in a layoff situation with COBRA, the employee would have the responsibility to continue the coverage if they'd like, but they would have to pick up 100% of the cost, or they may be forced to pick up 100% of the cost for the plan and administrative cost. And that can go up to 102%. Whereas with a furlough, that employee-employer relationship is still intact. So the benefit continuation is still there. There's still a responsibility for the employee to maintain their contributions as well as the employer. And if you do go through a layoff situation, keep in mind, if things get back to normal for your business or you are able to bring employees back earlier than you anticipated, keep in mind the 13-week rehire or parity rule that was put in place via the ACA or Affordable Care Act. Greg, next slide. With furloughs, taking a deeper dive real quick into the benefit continuation aspect of this, I've gotten a lot of questions from employees looking at this direction or this strategy with business continuity. And they've been very concerned with, well, my employees' hours have reduced, or they're not going to be able to pay their premiums because they no longer are getting any income. So what does that look like, and what can we do? Well, there's really 4 ways that you can navigate this as an employer. The first is to have the employee prepay their premiums up front. The second would be to have them pay as you go and to work out some type of agreement between yourself and the employee. I would recommend that is going to be difficult. I would recommend the third strategy, which would be the catch-up provision. But what I'd also recommend in this is that you establish an agreement with the employee up front. It's going to be very, very difficult after the fact to go back and tell an employee, you owe us 2 months of premium, whereas you may be able to early on strike an agreement of a payment plan, not a lump sum. And the last strategy would be for the employer to pick up the cost of the plan 100%. And I have seen that due to employees being furloughed because they have no decision or or reasoning of their own. So as an impact, employers are sometimes picking that up. Next, some of the layoff and furlough strategies, like I said earlier, have been impacted or offset by some of the recent legislation. And really right now is very similar to what we had back in 2010 when we had a lot of uncertainty in the market created by legislation, when the Affordable Care Act hit. And right now is really where a broker turns from a benefits broker really into a benefits consultant. And that's because of the legislation that has occurred. So most of you probably now are probably familiar with the Families First Coronavirus Response Act, or FFCRA. It was signed into law by President Trump on March 18th. It went into effect on April 1st, and it was targeted to assist employers with less than 500 employees. And it does have for some smaller groups under 50 employees, there is an exemption that you can navigate through in order to remove yourself from the requirements of the expanded family leave and the paid sick leave. And those are actually the two main components for the FFCRA. It did impose a paid sick leave requirement for employers and an expanded FMLA, which now has to be paid in comparison or in abstract to what we had previously with FMLA, which was unpaid leave. So a lot of changes there and navigating that. The good thing is that the FFCRA does have a sunset provision. It will end on December 31st of 2020. But we do have to examine those two components of FFCRA very closely and help our clients with keeping up to date and navigating when an employee would be eligible for a paid leave or a expanded family medical leave. So Greg, if you don't mind going to the next slide. And I apologize, I'm going very quickly through all this, but I'm trying to keep us as close to that 1 hour mark as possible. But with the paid sick leave provision under FFCRA, again, it was targeted for employers with less than 500 employees. It does not apply to medical providers, so nursing homes and healthcare organizations. They're exempt from the paid sick leave requirements. And it does not have a requirement for a length of service for an employee. So there's no wait period. So as soon as someone was hired, they have the opportunity to receive the paid sick leave if they're diagnosed with COVID-19 or one of the other triggers. But I have gotten a lot of questions regarding what triggers, and I would urge you to go to the DOL website. They have now released their 4th round of frequently asked questions, and I've gone through each one of them as they come out and perused them. They're typically about 100 questions long. So I don't expect you to go there and look at each one, but it just shows you if they're putting 100 questions on these FAQs that they're posting, every one of these questions is unique and different. And you probably have similar questions, but they may be slightly unique from something else that's been asked. So if you have questions, contact us. I'm happy to help you navigate that. Our whole team is. But some of the common questions that I've received is, well, my employee doesn't feel comfortable coming to work. They don't feel safe. So, do I have to pay them? And the answer is no. There's 6 very strict criteria to triggering the paid leave. And those 6 criteria are: the employee is subject to a federal, state, or local quarantine or isolation order. The employee has been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19. The employee is experiencing symptoms of COVID-19 and seeking medical diagnosis. The employee is caring for an individual who is subject to an order as described in Section 1 or 2, which would be the self-quarantine or a federal, local, or state order. And then the other 2 provisions deal with the closures of schools and daycares. And what you'll see is for the first 4 criterion, the paid wage amount can go up to $500 a day. Now, the good thing is this only is eligible or only paid for 10 days, and it's capped at $5,100 roughly. For the last 2 criterion, 5 and 6, for the closures of daycares or schools, the amount can go up to $200, and it's also capped at $2,000. Now, that last 2 criterion segues perfect into the expanded medical leave, family medical leave provision, like I said, the first 10 days of the paid leave, it applies. With the paid family leave provision, the first 10 days are unpaid. So the intent here, unfortunately for our employer groups, is that an employee's daycare closes, they have to now be at home caring for their child, they can't come to work. The first 10 days, the employer's on the hook for up to $200 through the paid sick leave. And for 10 days on and up to 12 weeks through the expanded family medical leave provision, the employee is eligible for 2/3 of their normal regular wage rate. There is an availability or an eligibility wait period for the paid family leave, and that is 30 days. The third provision that came out was the Coronavirus Aid, Relief, and Economic Securities Act, or what we commonly refer to as the CARES Act. Most of us right now, this has been a very hot topic because we had the money that was coming out, being pumped out to individuals, coming out to businesses in the form of the PPP grants. So this has been a very hot topic, and there's been a lot of additional webinars on this. But there are a couple key provisions that I want to point out to our employer groups listening. And that is, as of right now, the CARES Act expedited the FDA's approval process for prescriptions. And that was in an attempt to speed through these vaccines for coronavirus. Now, the concern for me there on a brokerage side is, are our pharmacies and manufacturers going to start to try and sneak through other prescriptions and things on this while this fast track process is available and get them to market? We don't know that. We don't know what type of restrictions have been put in place, but we might see more specialty drugs coming onto the marketplace, which would be higher cost through this expedited process. The CARES Act also clarified and solidified the cost-sharing waivers that we've seen from our private insurers. So like I mentioned earlier, Capital Health Plan was really quick to get out there and publish bulletins about what they planned on doing. Then the CARES Act came through on the back end and said that this was going to be something that they required private insurers to do. The other thing here with the CARES Act is it does have a direct impact on retirement plans. And that is, previously there were withdrawal taxes or penalties for individuals withdrawing funds from the retirement accounts. The Coronavirus or CARES Act has waived a 10% penalty that would typically apply as long as the withdrawal from the retirement account is due to a coronavirus-related distribution. And the CARES Act also increased the loan amount available for withdrawal from a retirement plan from $50,000 to $100,000. So if there's a coronavirus-related impact, members would be able to withdraw those funds in accordance to the regulations through CARES Act. And then last and not least is the changes that we've seen with over-the-counter drugs being compensable through HSAs, HRAs, and FSA. And we are staying in tune. There has been a lot of discussion and swirlings about right now with a fourth legislative initiative. We don't know currently what the topics or approach is going to be to that. It appears as though it's going to be another tranche of PPP style grants. That is yet to be seen, and what health care implications that potentially could have. So I know I went very quick, but in wrap up, one of the things, again, that I would urge you all to do is to, if you have questions, contact a broker, contact a trusted advisor. I'm, again, happy to go through any of the questions that you may have, but take advantage of the relief that carriers are providing. If you are under a financial hardship, utilize the grace periods. They're there for a reason. The carriers understand that. Educate your employees. Greg hit on it earlier. This has been very stressful for a lot of employees. So be sure to keep in communication with them and educate them about what's covered on their benefit plans for COVID-19. Talk with them about the expansion of qualified medical expenses as a result of CARES. I can tell you right now, as we go through some open enrollments, we're not changing benefit programs for a lot of our clients. We're keeping things as is. And what we're focusing on is making sure that groups that have Guardian understand how Guardian's ancillary products may trigger in response to COVID-19. And we're relaying that to the employees to give them some sort of comfort level that there is a financial safety net if they have a diagnosis. Promote telemedicine. I was talking to one of my carrier partners recently, and the general number that was given was, as a result of COVID-19, this group specifically had seen an increase in utilization. They had since COVID-19 occurred, 2,100 telemedicine utilizations. Now, the reason why I bring that up is that is a huge increase over a 45-day period, but also to give you an illustration of, typically there's a copay for telemedicine, and it can be $15 or $20 for every telemedicine visit. Now, if you just do the simple math, that's roughly $50,000 that just through telemedicine, carriers are now absorbing the cost on. So as we look forward again into the future, as we look at our renewals, those are the types of dynamics of not just telemedicine, but inpatient emergency room visits as a result of COVID-19 that we have to keep in mind. But promote telemedicine. It was on the up and coming previous to COVID-19, and now it's really been on the forefront. Kaiser released a recent statement that due to working from home and stress from COVID-19, 45% of employees that have transitioned to a work from home employer relationship feel like their mental health has been hurt at this time. So we're still early in all this with working from home. It's a major transition, but really feel empathy and work with your employees on their mental health, on clarity, and providing for them employee assistance programs and making sure that they're aware of what's available. And lastly, help your employees get used to the new normal. I opened this up with a humorous illustration of what the workforce or workplace could look like as we return. Get employees used to that. Have discussions maybe before they come back to the workplace about what policies you're implementing. Will there be temperature screenings up front so that they're not taken aback when they do come back to their typically normally safe and accustomed office? And the last thing that I am really proud that Brown & Brown has taken the initiative and moved forward with is, Greg and I in our organization here locally on a local basis, we're happy to partner with the chamber in doing these types of presentations to communicate clearly and effectively the resources that are out there. But within our organization, very early on, as Greg said, we took a quick stance to be able to help our communities. And we have on a local level released the opportunity for those here in our community to access our Brown & Brown Relief Center. It is available to everyone, all member groups, all employees of member groups, not just our clients. And it will provide things like health and behavioral health services. It'll provide assistance with financial wellness through Prudential Financial. So you can go in there, and during a time of financial hardship on an individual basis, you can have your employees work up a budget. They can start working through potential strain in finances. It also provides discounts for things like Sam's Club memberships, meal delivery services, home and home office discounts for things like Office Depot if they're still working on a remote workplace. So it has a lot of discounts that can be applied. And we even have connected with some of our local food vendors and restaurants here in town that they have jumped in to do a discount program or some type of coupon program for their restaurants as well. And with that, I will roll things back over to Greg or Dana to wrap up.
I'm here. Thanks, Doug. Thanks. Appreciate all your comments. I know it's hard to try to pack all that in an hour, but want to thank everybody for their time. We really greatly appreciate it. Just some closing comments, and I'll open it up for questions, but I did put the link for the save the date for this Friday at 2:00 is our next live stream video. It's the 6th edition of it, and it has the link for you to go register there. And I think some of the topics are going to be medical responses, antibody testing, returning to the workplace, some behavioral health issues, and then some employer guidance for more workplace safety issues as we return to the workplace, or potentially return. So with that, Dana, I'll turn it back over to you. If anybody has any questions, we'd love to answer questions at this time.
Great, thank you guys. Thanks, Greg, thanks, Doug. There were 2 that were submitted that I was able to respond to. They were just making sure that we were going to be able to send the slides and the recording. So we will be sending those out to everyone who attended today. It'll also be posted on the Chamber's website. The video will be uploaded to our YouTube channel, so that will be there as well. And I will also piggyback on the information that Greg put here. We've also put those on our COVID webinars page, so you guys can access those there as well. But those were the only 2 questions that were written. I think you guys did a great job of explaining and the bullet points and the slides. So appreciate the time, appreciate the members jumping on. And with that, we will close out today. And I thank you guys both for being here and helping us get through this COVID-19 pandemic. And we look forward to seeing everybody in person soon.
Great. Thank you.
Thanks, Dana.